I'm going to be demonstrating problem E8-8, which can be found on page 362 in your text. It can also be found in the Chapter 8 practice problems in Connect. It's the first problem demonstrated. If you have not yet read Chapter 8 or watched the interactive presentations for Chapter 8, please end this demonstration, go and read those or watch the presentations, and then come back to view this demonstration. Also, you may want to print out the worksheet that you see before you now. It can be found in the Chapter 8 folder in Blackboard. If you recall from your readings, there are two objectives when accounting for accounts receivable. First, the receivables should be stated on the balance sheet at the amount the company really expects to collect from its customers. We call that the net accounts receivable or the net realizable value. We also want to match the cost or expense of bad debts to the accounting period in which the related credit sales occurred. And we can accomplish both these objectives by using the allowance method. Now, there are two ways to estimate the amount that we're going to be used in the year-end adjusting entry to match the bad debt expense against the same period that the credit sales occurred, and also to make sure that the receivables are stated at their correct amount, the amount we expect to receive. So let's look at problem E8-8, and we'll learn both methods of estimating bad debt expense. Innovative Tech uses the percentage of credit sales method to estimate bad debts each month, and then uses the aging method at year end. During November, ITI sold services on account for $100,000 and estimated that 0.5% of those sales would be uncollectible. Now, our first requirement here is to prepare that November adjusting entry for bad debts. And remember, they said that we will be using the percentage of credit sales method to estimate bad debts during the year, and then at year end switch to the aging method. Well, regardless of the method, the journal entry is the same. It's a debit to bad debts expense and a credit to the contra asset account, the allowance for doubtful accounts. Now, with the percentage of credit sales method, we merely multiply the expected percent will be uncollectible based on that company's history, 0.5%, times the current period's credit sales of $100,000. So I'll show you the calculation here. $100,000 in credit sales times 0.5% would be 0.005, and the amount of our entry will be for $500, a debit to bad debt expense and a credit to the allowance for doubtful accounts. Now we're at year end. At December 31st, year end, the total accounts receivable is $89,000, aged as follows. In the 1 to 30 day category, $75,000 is owed to us. In the 31 to 90 day category, $10,000 is owed to us. And in the more than 90 days old category, $4,000 is owed to us. And experience has shown that for each age group, the average rate of uncollectability is, in the first category, 10%, second category 20%, and the third category 40% respectively. Excuse me. So now we want to prepare a schedule to estimate the appropriate year-end balance for the allowance for doubtful accounts. In other words, how much do we think we will not collect of the total amount of $89,000 owed to us? So we're going to fill out this aging schedule. In the 1 to 30 day category, it said $75,000 is owed to us. In the 31 to 90 day category, $10,000. In the more than 90 day category, $4,000. Now, what percent do we think will not be collected in the 1 to 30 day category? They told us 10%. In the 31 to 90 day category, 20%. And in the over 90 day category, 40%. We would get those percents from our history. What had we not collected in those categories in the past? Now all we have to do is multiply the total amount owed to us times the percent we think uncollectible to get the dollars we think we won't collect. So 75,000 times 10% would be $7,500. 10,000 times 20% would be $2,000. And 4,000 times 40% would be $1,600. Now let's total. If we add up our accounts receivable across the top, it should match the 89,000 here. 75 plus 10 is 85 plus 4. Yep, it equals 89,000. We will not be adding across the percents, but we will be adding across the amount we think is uncollectible. 7,500 plus 2,000 plus 1,600 equals $11,100 we think we will not collect of the 89,000 that is owed to us. So 11,100 is the desired balance in the allowance for doubtful accounts. In step 3, they want us to prepare the adjusting entry for year end using the allowance method, the aging method to estimate the amount. So again, the entry will be the same regardless of how we estimate it. A debit to bad debt expense and a credit to the allowance for doubtful accounts. But with the aging method, we have to take into consideration what the current balance of the allowance account is. And before the end of the year adjusting entry is made, the allowance for doubtful accounts is a $1,600 credit balance. Well, we want it to be 11,100. So how much more do we need to add to that allowance account to go from 1,600 to 11,100? Well, let's subtract, and I'll show you the subtraction here. You wouldn't do this in a real journal entry, but just to show you how we're going to calculate it, 11,100 is the amount we think we won't collect based on the aging schedule, and subtract from that the balance that account currently has, $1,600. And the difference is the amount we need to add to the allowance account. And the difference is $9,500. Once this journal entry is posted, the allowance for doubtful account will have a credit balance of our desired amount of 11,100. Now we've just demonstrated the two methods to calculate the amount for the bad debt expense entry, adjusting entry. This company uses one method during the year called the percent of credit sales method, and then at year end they switch to the aging method. A company could use one or the other, or as in this case, both. Now at year end on the balance sheet, we have a partial balance sheet here showing just the receivables. How should it be shown or depicted on the balance sheet? Well, we should list the amount owed to us in total, 11,900. I apologize. 89,000, and subtract the 11,100 allowance for doubtful accounts, and the difference will be our net accounts receivable, or accounts receivable net of allowance, or the third name you can call it is the net accounts receivable. Now that's where your problem will end on Connect, but I wanted to demonstrate write-offs and recoveries using this problem as well. So let's say it's the next year, January 10th of the following year, and we finally decide that Smith's account cannot be collected. We've exhausted every method of collection, and we cannot get Mr. Smith to pay his $1,000 that he owes us. So we decide to take his account off of our books. We call that writing off the account. We do that by debiting the allowance for doubtful accounts for the amount of the write-off, and we credit the customer's accounts receivable account. And that will effectively take the amount that he owes out of the accounts receivable account and eliminate it from our books. Now we will also call TRW or Experian and report that he did not pay on his debt and we had to write off his account. Let's say subsequently he decides to send us a check for $500. Perhaps he found out that his credit rating was hurt and he came up with $500 to pay us. The problem is that by crediting accounts receivable, we took his account off of our books. We could debit cash, but what would we credit? His account is gone. So your first step, if you have a recovery of an account that was written off, is to reverse this entry we just did. You're going to debit accounts receivable and credit the allowance to put that account, to put that account back on your books. But we're only going to put it back for the amount that the check is for. He may decide to pay us more later on, but we'll only restore it for the amount that the check will be for. Okay, so now the accounts receivable account is back on your books and you can debit cash and credit that customer's accounts receivable account. There we go. So we've done our entries for our year-end adjusting entry under both methods of estimating bad debt expense, percentage of credit sales, and the aging method. We've also shown you how to write off a bad debt and to record a recovery. Have a great day.